Hello everyone. Today I'll be doing a presentation on UK clothing retailing sector performance and strategy for the module Business Analytics and Intelligence. The presentation will follow a logical flow, beginning with an introduction to the industry and the data context. We will then move into the core analysis, starting with an interactive dashboard and a descriptive analysis of key trends. The later part will focus on predictive analysis using multiple regression and correlation to identify the quantitative drivers of profit and turnover. I'll conclude with strategic recommendations derived from the data-driven insights. The UK clothing retailing sector is a major part of the economy. This pie chart shows the industry market share by company for 2024. The key takeaway here is the sector is highly fragmented. Other companies account for a dominant 81.6% of the market. Among the top players, Primark leads with 6.8% of market share and followed by next group at 6.2% with a close gap. The line chart illustrates the annual revenue trend, showing a stability up to 2019, but then a sharp dip around 2021, which is likely due to the pandemic, but then a strong recovery trend towards 2024. Our analysis is based on a 10-year dataset from 2015 to 2024, giving us 50 data points across five key retailers: Next PLC, JD Sportswear, Marks& and Spencer, Primark, and ITX. The key outcome variable we are aiming to forecast is profit before taxation. The four managed independent variables are operational and financial matrices that a management team can directly influence, and these are number of employees, liquidity ratio, gearing percentage, and net tangible assets. Turnover is used as a contextual variable to understand overall scale and for correlation analysis and to do intercompany comparisons. The dashboard provides a high-level visual summary of the five companies' performance across profit and turnover over the decade. Let's zoom into profitability. The time series confirms the severe drop during the pandemic period, especially for Marks and Spencer, which dropped below zero. Crucially, the average profit bar chart shows Next PLC dominating the peer group with an average profit significantly higher than all other analyzed companies. JD Sportswear also shows impressive performance and growth in profit over the last few years of the data. Looking at turnover or total sales, Marks and Spencer leads by a considerable margin, showcasing its scale. JD Sportswear shows the most aggressive growth trajectory in turnover from 2015 to 2024. The average turnover confirms M&S's scale advantage, but also shows the relative scale of Next PLC and Primark in the market. Before moving to statistics, a brief look at the data visualization choices. I used line chart to track the performances over time, and it's essential for identifying seasonality and long-term impact of a strategic decisions at a glance. I used bar chart to compare a discrete category, for example, profit and turnover. In this case, these are best for ranking competitors or seeking performance differences at a glance. I used pie chart to compare the market share of the companies as a whole. It is essential for comparing shares among the members at a glance. The summary statistics provide numerical insights into a dataset's contribution. The very large standard deviation in turnover is a key insight which confirms that the sector's high heterogeneity, meaning the companies we analyze are vastly different in size and scale. For profit before taxation, the mean and median are quite close. This suggests a balanced distribution without being heavily skewed by extreme outliers, making the mean a relatively good measure. The descriptive statistics are crucial for managerial insight. While the mean summarizes overall performance, it's sensitive to outliers. The median gives us a more stable and typical company performance level, filtering out any extremely high or low performers. Most importantly, the standard deviation is critically as a measure of volatility and risk. A high standard deviation in turnover emphasizes that a single benchmark is unreliable. This leads to the managerial insight that customized strategies are necessary due to the wide variations shown by the standard deviation. Moving to predictive analysis, we first look at the correlation metrics. The key variables, net tangible assets and number of employees, show a strong positive correlation with turnover. This is expected as large companies naturally have more assets and employees. An interesting finding is the strong negative correlation between turnover and return of capital employed. This suggests that simply growing scale does not guarantee better capital efficiency across the entire data set. If we look at the liquidity ratio, it has a weak positive correlation with turnover. Gearing percentage has a weak negative correlation with the turnover, and number of employees have a strong positive correlation with the turnover. I also developed a multiple regression model to forecast the dependent variable profit before taxation using our four managed independent variables, which are profit, net tangible assets, liquidity ratio, gearing percentage, and number of employees. The R squared is 0.403. This means that the four matrices account for 40.3% of the variance in profit before taxation, giving the model moderate explanatory power. The very low significance F confirms that the model as a whole is statistically significant for prediction. Looking at the p-values, three of the four independent variables are statistically significant. Liquidity ratio, this has a p-value of 0.001, making it highly significant and has a large positive coefficient. This is our strongest profit driver. Better working capital management directly correlates with higher profit. Number of employees has a significant and a positive coefficient. The p-value being 0.002 makes it statistically significant. Operational scale, when efficient, will drive profitability. Talking about net tangible assets, this is significant as well with a p-value of 0.002 but has a negative coefficient. This is a counterintuitive and suggests that for this data set, overinvestment in fixed assets like physical stores might be dragging down profitability. Talking about gearing percentage, it's not a significant measure statistically because of its p-value being 0.139, suggesting that financial risk structure is not a statistically reliable predictor of profit in this model. Talking about the coefficient, the intercept coefficient being negative 15679.21. Here's the equation to find the to predict the profit before taxation using the coefficients and the values. Moving on to recommendations, focusing on financial health first, we need to prioritize and protect the liquidity position. The liquidity ratio has a strong, most significant positive coefficient in the profit model. And to improve that, we implement rigorous working capital management systems that focuses on optimizing inventory, turnover, and accelerating accounts receivable. Moving on to asset strategy, we can adopt a capital light model for fixed assets. The statistically significant yet counterintuitive negative coefficient for net tangible assets suggests that high investment in a fixed asset is currently dragging down profitability. We can strategically review the existing physical footprint, focus new investment on agile, high return logistics, and digital infrastructure rather than expanding traditional high cost physical stores. Moving on to operational scale, invest in high productivity human capital and technology. The number of employees is a significant positive predictor of profit. We do not need to merely cut staff, but focus on improving employees' productivity through technological enablement, training, and automation. Moving to market positioning, we need to develop a custom benchmarks and segmented strategies. The large standard deviation in turnover confirms the significant size differences in the market. This makes us understand that high growth firms like JD Sports need to focus on capital efficiencies, while large players like Marks Spencer need to leverage their size to reduce operating costs and increasing margin. That'll be all for me for today. Thank you for your time and patience.